There is one big problem holding most young people back financially.
Housing has put home ownership beyond the reach for many.
If you don't already own a home, you probably can't afford one, and you probably can't even afford to rent one either. If your dream is a housing crash that will level the financial playing field, then I am sorry to tell you, but that's probably only going to make things worse.
Out on a hunt for housing, but feeling overwhelmed by the soaring costs.
Property prices are rising across the U.S., and that is, in fact, in part because of these higher interest rates.
Are real home buyers and sellers alike feeling a massive struggle to close deals or make money?
Housing is becoming more expensive for buyers and renters alike.
According to the real estate data firm Adam, homes are now unaffordable for median Americans in 99% of counties they analyzed. The remaining 1% were not affordable. There just wasn't enough data to use in their report. With statistics like these, the only hope that a lot of Americans have is a market correction that will bring prices back down. High prices aren't good for many people. Buyers can't afford a home, renters are stuck in a market where more than ever they need roommates to afford rent. And even though 2/3 of Americans own their own home, high prices aren't that great for them either. If you are one of the lucky people that own a home and you sell it for a record price, you still need to buy another home, which is just going to cost you a record price, leaving you no better off overall. While you own your home, you are going to pay higher property taxes, and if you do sell your home to buy a new one, you might have to pay capital gains. Most homes in America are now selling over the IRS's Section 121 exemption of $250,000 in profit since you purchased the home. So, if your home is worth a lot more than you bought it for, and you don't want to live on the street once you sell it, the only person you have really made money for is Uncle Sam.
Congratulations, you played yourself.
The only people who are really winning off that own multiple properties in addition to their primary residence. If the prices are too damn high, then the best thing you could hope for is a market crash, right? Wrong. I am once again here to crush your dreams and tell you that a housing crash would probably only make it harder for you to buy a home for 3 simple reasons. The first reason is that if you are not in a financial position to buy a home right now, a real estate crash would put you even further behind. Today, you can buy a house with as little as 3% down from lenders across the country. So if you can't get into a house right now, there is probably something other than the down payment standing in your way. And unless house prices drop by 97%, you aren't going to be able to pay cash. According to the Department of Housing and Urban Development, average house prices fell by just 20% in 2008 from their peak in 2007. This was the worst housing collapse in history, so a 97% drop is unlikely. So that means if you can't buy a house now, then even after a market crash, you are still going to need a mortgage. According to a survey commissioned by NerdWallet and conducted by the Harris Poll, 37% of non-homeowners said they didn't have enough saved for a down payment on a mortgage. But a larger group, 42% of respondents, couldn't buy a home for a much more annoying reason. Lenders want to ensure 3 things when you borrow money from them. They want to make sure you have a down payment, the bigger the better. They want to make sure you have good credit, and they want to make sure that you can make your payments. The systems and criteria that lenders use to determine your ability to repay a loan are made up by the risk departments at the banks, and are kept private because it's considered a business secret. Normally, these rules are highly risk-averse, which is why you might get a mortgage application declined if the bank decides that you can't make repayments even if your repayments would be less than you're currently paying in rent. Every lender has a different set of rules, and they can change them at any time. Income from a full-time job is treated differently to part-time or gig work income. Some banks prefer income from business owners, and some won't lend anything to them. I wanted to buy a house at the end of last year, but when I told my bank that my income came from YouTube videos, they politely but firmly told me to get out of their office. Lenders also treat expenses like student loans, dependent family members, and other debt payments differently as well. All the different rules can get confusing, but they all have one thing in common. If the risk department says that home lending is getting risky, they are going to make it even harder to qualify for a mortgage to balance that risk. After a housing crash like 2008, lenders got much more conservative with who they would lend that money to, which back then was a good thing. But now, in 2024, if your income is not good enough to qualify for a mortgage now, you are going to have even less of a chance to qualify for a loan if real estate crashes. According to the National Association of Realtors, the biggest drop ever in the number of homes being sold in America came after 2008. This should have been the perfect time for the number of home sales to jump because prices had fallen significantly. The number of listings was inflated from foreclosures and interest rates were at record lows. But what actually happened was exactly the opposite. There were people that wanted to buy these houses, but nobody would give them any money to do it. And unfortunately, that's just the first reason. So it's time to learn how money works to find out a real estate crash probably won't get you any closer to owning a home. This week's lesson is sponsored by Brilliant. Brilliant is the best way to learn math, data science, and computer science interactively. Whatever your skill level, Brilliant customizes content to fit your needs and lets you solve problems at your own pace. When I was younger, I learned basic programming with PHP, and throughout my life, I've always thought that thinking about things in the terms of code helps me to make sense of things, even when things can't be explained by nested if statements. Brilliant has a course called Thinking in Code, which is exactly this. You can build solid foundations for computational problem solving and help make sense of the world in the context of code. There's so many great courses on Brilliant that I've had it for over a year and a half and I use it regularly, but I still haven't been able to tackle all of them. It's a challenge that I personally have set to try and tackle as many Brilliant courses as I possibly can. Best of all, you can learn anywhere you are from your desktop, phone, or tablet. Brilliant makes learning fun and enjoyable, and if you like my channel, you'll enjoy learning with Brilliant. To get Brilliant for free for 30 days, go to brilliant.org/howmoneyworks or click the link in the description, and the first 200 of you will get 20% off Brilliant's annual premium subscription. Talking about a real estate crash is one of the most popular finance subjects here on YouTube. Videos warning you about the imminent real estate collapse have regularly been getting hundreds of thousands of views for years. Any day, they might come true. The reason these videos are so popular is because people think that if they are right, then this could be their one chance to buy a home. Some influencers even talk about the investment opportunity that a post-crash real estate market could present. And aside from the titles and thumbnails, some of these videos do make a compelling case. I am trying to be a bigger person in 2024, and I'm not going to name any names. Instead, just focus on the subject. So, I am just going to list the long list of problems you are going to face if you try to buy the dip in real estate. For house prices to fall, one of three things needs to happen. The first thing is that buyers across the country lose their purchasing power because of mass unemployment or because banks stop lending them money to buy a home. The unemployment rate is near all-time lows, and if banks halt lending, then that's not going to help you buy a home unless you plan to pay all cash. If unemployment does rise, then young hopeful homebuyers are likely to be the first people laid off. You might be lucky enough to avoid getting fired and convince a bank to give you a loan, but there are other groups who don't need that luck. In 2011, the investment bank Morgan Stanley sent out an industry report to their clients titled Housing Market Insights, a rentership society. The report opens with the bank's analysis that after the subprime mortgage crisis of 2008, the combination of falling home prices, limited mortgage credit, continued liquidations, and better rental options is fundamentally changing the way Americans live. They were advising their clients, who are either institutional investors or ultra-high net worth individuals, that regular Americans were being evicted, nobody could get a loan, and people that lost their homes needed a place to rent. So it was a perfect opportunity to buy up residential property while nobody else could and jack up rents on people that had been evicted. The Morgan Stanley report was horrendously tone-deaf, but it wasn't actually wrong. Today, the average American home earns more than the average American, which is why the second reason that housing could get cheaper is even less likely to help you buy a home. The number of existing home sales in America is once again approaching levels that haven't been seen since the 1980s, when the population was half of that today. People who have locked in low interest rates are not going to sell their homes unless they are forced to, because if they buy a new home with a new mortgage, they will be paying twice as much out of pocket every month for the same place. A report by the Wall Street Journal found that even if people needed to leave their home to move cities, they were just renting out their home instead of selling it, because they could keep their sub 3% mortgage rate and charge record high rental prices. If you own a home right now, there is no reason why you would want to sell it. A flood of forced sales is much less likely today because lending standards are tighter than they were in the lead up to 2008, so most existing owners should be able to comfortably afford their mortgage. So, alright then, if people aren't going to sell the homes that already exist, we should just build more homes. This really is the answer. But according to the Department of Housing and Urban Planning, America is building fewer homes now than it was when we had half as many people. By now, I am sure you are all familiar with the problems caused by zoning, NIMBYism, and local building codes. These are all making the construction of newer homes slower and more expensive. A report by The Atlantic found that nearly half the cost of building a new home came from local rule and preferences rather than just materials and labor. There is another, even more simple reason why nobody is building new houses, and it's also the third reason why a real estate crash won't help you buy a home. A real estate developer needs to buy land, build a home, and then sell that home and land for more than they purchased it for. It's simple. But when land is so expensive, builders can't buy as much of it to build on. Back at the peak of home building in America, most of the operating margin was in the home construction itself. Now it's in the land. So even if a builder constructs a house on time and on budget, they risk losing money if the market swings by just a few percent against them. Builders typically fund construction projects with development loans, which are also expensive right now thanks to high interest rates. It's become a safer investment for developers to just renovate and flip existing homes instead of building new ones, because they can turn projects around faster and they don't have to deal with as much red tape. The only thing that could slow construction down even more is a collapse in real estate values, because if land prices are falling, then builders are not going to risk holding on to lands to build on. If you look at the data collected by the Department of Housing and Urban Development, you can see clear drops in new construction lining up with drops in home prices. Millions of people, particularly young people, not being able to afford a home is one of the biggest problems in America and a lot of other places around the world right now. But waiting for a crash to fix your problems will probably leave you very disappointed. In the last 400 years, real estate has gone from being owned exclusively by elite noble lords to something that the average family could buy. And now, it's becoming so expensive again that only elite landlords could afford it. To find out if this was inevitable, go and watch my video on the 400-year cycle of real estate over on How History Works. And remember, to get these videos a day early before everybody else and read topics that can't be made into videos, go and subscribe to my completely free email newsletter in the description to keep on learning how money works.